We mentioned that we're delighted to have a guest with us, with Agam from Vector Capital today. And you've been a long time exponent on this show about alternative investment opportunities, because there comes a time in your life where you might be fortunate enough to come into some money from various things happening, family and property and so forth. And the natural thing that people seem to do is to go and buy a property, rent it out, and get themselves an income, which you can't criticise. But at the end of the day, do you really want all the hassle of having to look after tenants? Do you have to have all the hassle of complying with the law, which is getting ever more complex? And you've often said that there should be an alternative, and I think that's why you wanted Agam to come and talk to us today about co-funding.
Yes, Paul, thank you very much for that, and welcome, Agam. My beef has been for many years that there isn't an alternative. There comes a time in a lot of people, and I see this literally at the front line, where people have got investment money and they're at a certain time in life. So, without any discrimination or prejudice, I mean, you get to a certain point, 55, 60 years old, you want to start to think about enjoying your life. You've done your turn, and then all of a sudden you think, well, I'm not getting enough income from a pension. I'm not getting income from my savings because the ISA is only giving me, XYZ amount of interest on return. I've got a couple of £100,000, maybe 100,000, even maybe £50,000. It really doesn't matter about the amount. The main thing is that you're not getting the best form of return for your money. And so over my time, I came across Agam and Vector Capital, and I came across a concept that I thought I'd really love to bring to our show and bring to my clients and bring to my and our viewers here. So that's why I invited Agam to come and join us and share with us the benefits. So I'm going to outline what I see, and then hopefully Agam can support that and help us with what we think it is. I think that there comes a time when people say, well, actually, I'm going to go and rent or buy a house or a flat for a couple of £100,000 for argument's sake, then they're going to get a rent return on that, maybe around £1,000, between £800 and £1,000 a month. But what they have to bear in mind is there is also costs after that. For example, there are going to be buildings insurances, other insurances, and then of course some sort of agency fees that you're going to be paying out on, and so forth. I think probably for me personally, the reason I bring this to our viewers is that there is a huge amount of work that is involved in earning perhaps a little when you could actually probably enjoy your life and have a safe investment. Again, what attracted me about this is that investment is in property. So we are property matters. I love property. It's what I sing and dance about every day. And as far as I'm concerned, this is an investment in property, except you don't actually have to go and buy your own couple of 2-bedroom, 1-bedroom flat. You can actually co-invest with Vector Capital, and they will give you a return which is much higher. And it's always about individual circumstances. So I'm not going to state what and how much, and that is something that you would have to approach Vector Capital and Agam, and they will put you a proposal that they feel that they could offer. But the things that I have seen so far, and for the clients that I have recommended so far, they have been quite surprised at what they are getting. And they are getting, I get that, sitting at home and not having to think about the leaky tap. That's the way I look at it. Agam, welcome to our Property Matters show. I know you've been here before. I'm a supporter of your co-funding, and I'd like you to share how our viewers and potential clients that we may refer to you who would benefit from that.
Thank you, Jeff. So, Paul, do you want to move the slides then, I suppose?
Yeah, tell us a little bit about Vector Capital first, if you would. That'd be great.
Okay, so a little bit of background. We did our first loan in 1999, so I think that makes this year 23. So there's a bit of experience there. And what we do is we provide bridging and property development finance throughout England and Wales. We concentrate on the sub £3 million size of the market. So we're not doing huge projects and risking a lot of capital on one big project. But we've got a very large spread, both geographically, and average sort of loan size that we do is about £600,000, with quite a few that are around 1.5, 2 million. So there's a good geographic and a size spread. The type of people that will come to us are small developers that will find maybe a dilapidated house or an old office building, and then they'll want to convert it to flats, and then either rent them out or sell on, or then transfer it to a buy-to-let mortgage. So that's our market. The main thing to know about the Vector Capital as well is that we're a very professional company. We're listed on the London Stock Exchange, and we've got an excellent track record. And everything that we do is public information. You can go to our website, or you can go to the London Stock Exchange website, download all our accounts and growth figures from the internet.
And how is Vector Capital regulated then in any way, or is there any regulation?
Okay, so regulation in the UK applies to people that buy houses that they're going to live in. Okay, so that is a sector that companies like us don't get involved in. You would go to somebody like Halifax or NatWest or Barclays for a high street mortgage on your own house. The type of people that would come to us are business people that would be buying the property for refurbishment, development, to let out, etc. And that sector is unregulated. Having said that, being a listed company, we are audited 9 times in a year. We've got bank lines, so they audit us every quarter, and then we have to have the big audit, and then we have to meet various requirements for the stock exchange. So we are sort of very heavily vetted and audited, but lending to the a sector where it's for development is not regulated.
Okay, so let's just talk a bit about the opportunity. Let's to explain what co-funding is, if you would, Agam.
Okay, so we market to hundreds of brokers up and down the country, and we're fed with various inquiries on a daily basis of people wanting to borrow money to buy property so that they can develop it, and we are able to charge a higher rate of interest than you can on a home mortgage. Now, we primarily fund this from our own capital and bank credit lines that we've got. Our capital comes from the fact that because we're listed, we've got a large base of shareholders. Now, say we get inquiries where we've funded it ourselves, but we can then offer that to people who want to co-invest. So we can publish a list on our website via invitation. So we give you a login, so you can go into our website. You can see all the properties that are up there that we financed, and that you may want to then come in and co-invest. So I think on the next slide, I'll be giving you an example. So shall we move to that one now, Paul?
Yeah, I was just going to ask you first, because you said you lend to people who are property developers, or smaller property developers who are obviously professionals in what they do. But this is a chance for people who don't necessarily have a great deal of property knowledge to invest in something that you have already vetted and had a look at yourself and think is a good opportunity. And as long as it's managed well, they can come in with you and assist. And that's what co-funding is.
Yes, but it can be easier than that, because the co-funder can also choose from the list of projects that we've got on our website which ones suit him. So, for example, I would say 80% of the loans that we issue are for people that are buying a property and just doing internal refurbishment. Yeah, there would only be about 5 or 6% that would be ground-up developments, that where somebody's actually buying land and digging it up and then building from the ground upwards. Okay, so depending on the comfort level, the co-funder can choose, okay, no, I'd rather just maybe fund a buy-to-let property where there's no development going on, but then the rate that we are able to charge and then consequently give on to the co-funder will be lower. where then the next stage would be internal refurbishment, where the rate that we would charge would be slightly higher, and so more is available for the co-funder. And if you got an appetite, then you can actually come in on a full development project where somebody's building a block of flats, or and then the rates that we charge would be higher, and then the return for the co-funder would be higher. Now, having said all that, we do a lot of due diligence before we issue any loan, because obviously it's in our interest, because we're funding it initially, to make sure that it's completely safe as can be. And to give you an idea of our track record, over the 22 years that I mentioned from 1999, we've never had to actually ever write off a capital loan. We have had to write off costs in recovery and maybe some accrued interest, but we've always recovered our capital. And all this information is public and is available on our accounts.
Okay, let's have a look at that example you mentioned there. So you've got a property here valued at 1.5 million. Tell us about this.
Okay, so say the property is valued at 1.5 million, and we've decided that we are happy to lend 1 million against that project, okay, or the property. Now, we'll have done that with our own money, but then we'll put it up on our website, and people that want to then come in on that can say, all right, well, look, I'm happy to come in at, say, 400,000, for example, on that property. I'm just doing larger rounded figures just so it's easier to understand. The projects can be much smaller as well. So what we would say to you is, okay, we've got our first legal charge on that site, okay? So if anything ever went wrong, we can just step in, sell the property and recover the money. Now, as a 40% co-funder, what we would say is that we'll give you a 40% share of the legal charge that we've got, so that if we end up having to repossess, whatever proceeds we will get, we will share with you in the 60-40 ratio. Does that make sense?
Yeah, absolutely. Okay, so let's just look at the deal structure. So about protecting the investment and the trust deed and that kind of thing. So the legalese, how does that work? How is the investor protected?
Okay, so we've gone to a great length to make sure that the legal protection for the co-funder is as good as it can be and is solid. We use the firm called Memory Crystal, which is a large city firm that specializes in this, to draw up sort of documents in plain, simple English. And what it basically means is that we've done the deal. We've got a first legal charge on the site. Okay, we will put that legal charge into a trust, and then the beneficiaries of that trust will be Vector and the co-funder. Okay, now the co-funder can be just one party, or there can be 2 or 3 co-investors in the deal. So somebody might come in at 200, somebody might come in at 100, somebody else might come in at another 100, and then Vector's done 600 on it. So that means then there's 5 parties in that trust, all being beneficiaries in that proportion, 60%, 20%, 10%, 10%. Okay, so that way the legal charge is there. So you've actually got bricks and mortar, a share in that bricks and mortar security.
One question that's just come to me as we're talking, Agam, does the co-funder have to come in at the start of the project, or can they join partway through? How does that work? Especially if there are others involved.
It's probably more convenient for us that we do the deal initially ourselves. Okay, then we put it up on the website and say, look, these are the list of deals that are available. Because say a borrower comes to us, we don't want to be hanging around whilst the co-funder is oohing and eyeing and thinking about it. We need to do our business and get the deal done. So we'd prefer to just do the deal, put it up on the website, so you can then come in at any stage. So say usually we'll give a loan for 12 months. So ideally what you should do is when there's still 11 months to go, maybe come in then so you can benefit for 11 months at least. Okay. Now, obviously, if you're going to come in just 2 months before expiry, then you're only going to get 2 months benefit. But so yes, you can come in after we've done the transaction.
Okay. So the transaction process, what happens here?
Okay, so initially what we'll do is you'll pick a project that you like from our website. What we'll do then is we'll give you a term sheet which will say, all right, for the 400,000 you're going to invest, this is what interest we're going to pay you. Okay. Then we will also give you a copy of the RICS valuation. RICS, I'm sure all the audience understands, is the Royal Institute of Chartered Surveyors. So we always get a valuation done by them, where we have various valuations. So one of the valuations we have is the market value, then 180-day market value. That means that if we possess the property and gave ourselves 6 months to sell it and complete. And then we also have a 90-day evaluation on there, which is that we want to put it in an auction and get rid of it quickly. Okay, so the co-funder can actually have all that data. The valuation will also give him all the property details, the pros and cons, photographs, street scenes, everything. That is 60-70-page document. We'll also then give you a very simple funding agreement written in plain English, so that you don't need a lawyer unless you want one to actually understand what it says. Once you've made your investment, we'll also give you an acknowledgement and a copy of the trust deed. Now that trust deed is going to be lodged with a firm of solicitors. So you don't actually have to incur any legal fees if you don't want to. But if you're extra cautious, you can also employ your own solicitor, but then you'll have to pay his fees and he can check over the documentation. But we use a large city firm called Gunner Cook, and they hold all the trust documentation, and they will write to you and acknowledge that they're holding it on behalf of the trust of which you, the co-funder, is a beneficiary.
Mm. And essentially anything that happens with that loan to the borrower, VEC to make all the decisions. So if they need further finance or if they want to pay back early, that kind of thing, you handle that on behalf of the co-funder. They don't get involved in that decision making.
No. So the co-funder is a silent investor. So our team at Vector will make all the decisions. And it often happens that somebody asks for a 12-month loan, and then at the 11th month, they request, can we have another 6 months? Can we have another 12 months? Now, it's usually in our interests to extend that loan, because then both parties can earn more out of it. So we usually agree to it. And during the lifetime of a loan, sometimes people will pay a little bit of capital back early if the progress is going faster than they expected. Or sometimes they'll ask for an additional advance. And what we will do as an underwriting task is to see if there's enough equity left to give them an additional advance, and if there is, we'll give them an additional advance. So, and a lot of times, well, I wouldn't say a lot of times, but several times, people may just feel that we don't need the money anymore, and they will want to redeem the loan. So, although we give them 12 months, I like to think of us as the Marks and Spencers of the lending business, where people aren't sort of tied down into knots if they want to redeem early. So we're not going to say to them, no, this was 12 months. You have to. So if after 8 months they want to redeem, we'll take it without any penalties. But the co-funder will also then get paid back simultaneously. So he might have anticipated 12 months, but there's a risk that he might get paid back earlier.
My old grandma used to say to me, there's many a spill between cup and lip. So sometimes things don't always go to plan, Agam. So what happens when things go wrong? How do you manage default?
Okay, so I'm in total agreement with you. For every 100 loans we do, there's only probably about 10 or 20 that are absolutely smooth. Okay, so it's a very high percentage where there's a lot of variation during the term. And it's the usual thing that I haven't got the cash flow to make my monthly payment this month. Okay, so we give them a bit of grace for maybe 2 or 3 months. So that's the most common thing. Then the other thing is that sadly, maybe 10% of them do get into difficulties. We try to be helpful and sort of show forbearance, but at the end of the day, we've got to protect the interests of the co-funder as well as ourselves. And so we'll usually say to them, look, try and refinance or get yourself sorted in the next month. If you can't, then what we do is then we appoint a receiver and we take over the property. And at that point, we'll make a commercial judgment. And this is where I've had lots of interaction with Joe. We'll either say, Joe, we don't want to be hanging around for 6 months. Can you put it into an auction? Okay. Or where we feel, look, it's better to spend the 6 months marketing it properly because we'll be able to achieve a much higher price. Okay. So then, so they're the decisions we make. But to put it in context, there's only about 3% of our loans that ever end up having to go to that stage. Okay. And 0% where we actually lose the capital. Okay. What we will often lose is the interest that's accruing since we put it into receivership, and then the costs of the auction company or the estate agent and the receiver. So sometimes we're not able to recover that. Okay, but the capital you'll always get back.
So obviously it's those additional costs of the receiver and the auction, etc. Those are the things that come out of what would have been the profit.
Yeah. Now, what we would do is we wouldn't get the co-funder involved on any of the recovery process. We would deal with all that ourselves, and we would pay the bills for the receiver and for the auction company ourselves, and then we would share the statement, give a detailed statement of what we recovered and what costs there were, and whatever is left over, which is usually more than we're owed. We would then split in the ratio 60-40 or whatever the percentage ratios was between the beneficiaries. And if there is a shortfall, then that's the co-funder would share that in his percentage as well. Yeah. So if there's a £1,000 shortfall, and so we'll be hit for 600, and then the co-funder for the 400. Yeah.
And I suppose the comfort for the co-funder is that you will have, of course, done your due diligence. You'll have done a risk assessment because you've got your own skin in the game, haven't you, as Vector?
Well, we're assuming that some co-funders will come in, but if they don't, it's all our skin in the game, isn't it? Yeah.
Yeah, absolutely.
And also, we don't probably want to be putting up deals where we think there's the slightest little chance that there might be something like that, because we want these co-funders, as soon as they get redeemed on one deal, to have the appetite to come back again and then tell their friends about it as well. Yeah. So safety for us is primary. If there were sort of like slightly higher risk deals where there's a lot of development, ground up development or something, we'd probably not invite co-funders on that anyway.
And if the worst thing happens, the trust structure cordons off the asset as well.
Yes, yeah. That is cordoned off. That's what the trust structure does. It cordons off the asset so that Vector doesn't have any further claim outside its percentage as a beneficiary.
Is this type of scheme quite common in the UK, Agam, or are you the only guys doing this?
No, there's quite a few people doing it. In fact, there's a lot of automated platforms of companies that just base their whole business on this basis. Okay, and what they do, there's a lot of peer-to-peer, for example. Although what our proposition isn't really peer-to-peer, because we're already doing the deal and we're asking somebody to come in as a co-funder. Whereas peer-to-peer is where somebody requires a loan for 100,000, and then you get 200 people coming in, with £500 each or something, and then when they built up enough, then the deal is done. But in the type of market we're in, we couldn't give that uncertainty to our borrowers. The borrowers that come to us, once their due diligence checks out, they're expecting to put in funds so that they can complete their transaction. So we wouldn't really want to do things like that. But the answer is yes to your question. There's a lot of people doing peer-to-peer, which is similar to co-funding, and a few people doing co-funding as well. But I think we're the only publicly listed company that's doing co-funding. So that, from the co-funder's point of view, is a big plus in terms of security. You're not dealing with a private company and relying on what they've told you. You can actually check out information out, from public websites.
So I'm committing my funds to you for a period of time, as you said, for example, say 12 months to keep the figures simple. But what happens if I suddenly need to get my money back in 10 months' time?
Okay, this is for big boys, but supposing you've given us 50,000, and then 3 months later, you say, look, I really desperately need that money. For us, because as a percentage of our turnover, that will be very insignificant. So we are in a position to say, all right, look, just for goodwill, we'll refund your 50,000. But what we'll probably do is say, well, look, you'll forfeit any interest that you would have had on it.
Yeah, so you get your capital back. But as you say,
Yeah.
that's not really what you're entering it into it for. And if you're going to think you're going to need that money, you probably shouldn't be doing this in the first place.
Yes, you know, and you'll know at the time what the term of the loan that we've issued, and you may also want to be ready that if we extend it, that are you up for extending it? If you're not, we'll still extend it, and then maybe at the end of that term, we'll say to you, look, you can have your money back if you want. Okay, but we're thinking that the type of people that will want to come in on this might have bought a flat, for example, that they would have had for the next 20 years. Yeah, so if they come in on us for a loan that was originally 12 months and then it gets extended for another 12 months, well, hey ho, that's, you know, benefit for you as well. It can be for 24 months. If it gets redeemed early, doesn't matter. Take the money back, and then you can put it into another site from our list.
And it's important that people should do their due diligence, not just on the investment, of course, but as you mentioned earlier on in Vector Capital, and you've mentioned already that all of your financial results are there in the public domain, and that you're vetted and audited 9 times a year. So there on the screen is the details that people need to have if they're interested. But also, let me put you on the spot finally, Agam, and ask you to give us some contact details of how we can get in touch with you.
Well, you can contact Joe, or you can contact myself. Our contact details are very easy. mail@vectorcapital.co.uk. And you'll see the enthusiasm that we come back to you with straight away.
And we've got a phone number on the screen there for Agam as well. Agam, thank you very much indeed. Fascinating conversation there. And Joe, quite an interesting opportunity for investment.
Yeah, I mean, it's probably the longest you see me sitting there silent, Paul. I know I've always got plenty to say, but I'm grateful and thank Agam for being absolutely clear and concise with the questions that you raised, and they're all questions that, to be honest with you, any of our viewers, listeners, and introductions would actually want to check on. I didn't want to bring Agam onto this program just because it was good for our health. I really wanted to bring him on because I think it's a really great opportunity for a certain level of person that has a certain amount of capital and doesn't particularly want to do buy to let. I think it's a fantastic alternative, and it gives a great comfort. The key in that is that, Agam and Vector Capital are doing it anyway. They are going to lend, they do their due diligence, they are in it, as you say, they have full skin in the game. But what they are offering is a co-funding, an opportunity for someone to feel that they're safe because they've done the due diligence, they have the larger part of the investment or the loan that they've done. And it gives them, for me personally, what I like to endorse in that is that it is bricks and mortar. Ladies and gentlemen, it is exactly what you do every single day of your life. You buy and sell, and you invest in property because property is the most safest and securest form of investment that you are likely to ever do. We know that. 40 odd years later, I can tell you that that's what kept me here. It's as safe as houses, as they say. It's the safest investment you're going to make. And what Vector Capital does is actually invest in exactly that and offer you a share. So if there's anyone that's out there that feels that they want to have a discussion on that subject further, please feel free to give me a call. You have all Agam's details, which is published there, and share this story with as many as you like. But I just think it was really key to bring this subject to the table. And thank you, Agam, for joining us today and sharing that. And hopefully together we will all benefit.